At some point, we're going to get to the point where the AI can act like an agent, where for low-value tasks, you're comfortable giving it permission to go ahead and send those emails, send the follow-up. And with that world, that's what really opens up all the different productivity-enhancing elements of technology.
T. Rowe Price's Dominic Rizzo on why artificial intelligence has the potential to be the biggest productivity-enhancing technology since electricity.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Royce Investment Partners, Baird, Bill Miller, Research Affiliates, Strategas Asset Management, Women Investing in Security and Education, and Matthews Asia.
Hello and welcome to this edition of WealthTRACK. I'm Consuelo Mack. For those of you old enough to have seen the movie The Graduate in 1967, there was a famous line, career advice given to Ben, Dustin Hoffman's character, at his college graduation party. Ben, I just want to say one word to you, just one word, plastics. What would that advice be today? It would probably be artificial intelligence. AI is being talked about, reported on, and invested in everywhere. Depending upon who you talk to, it's either going to change the world or destroy it. It's either just getting going or it's peaked. Well, one thing we do know is AI-related investments have soared and propelled the stock market along with it. Noted strategist and WealthTRACK guest Ed Yardeni dates the start of the current bull market to OpenAI's release of ChatGPT on November 30th, 2022. He discussed it in a recent WealthTRACK interview available on wealthtrack.com. Semiconductor stocks have been leading the charge, with shares of Nvidia, the premier manufacturer of AI chips, rocketing ahead. Nvidia, with an estimated 80% plus of the AI chip market, just joined the $3 trillion market cap club with Microsoft and Apple. It also recently had a 10-for-1 stock split, making its pre-split $1,000 plus shares more affordable for individual investors. We recently devoted a WealthTRACK episode to Yardeni's provocative assertion that AI isn't intelligent, that it had serious limitations, at least in its current form. This week's guest will counter that view with his belief that AI is potentially the biggest technical innovation since electricity, the title of a recent presentation. This week's guest is Dominic Rizzo, portfolio manager of T. Rowe Price's Global Technology Fund, which he took over from its former manager in December of 2022. In that brief period, the fund has considerably outperformed with a 70% plus cumulative return. In giving the fund a 2-star neutral analyst rating, Morningstar notes that the fund is off to a good start, but it's early, given Rizzo's relatively new leadership and overall of the portfolio. The fund has beaten its Morningstar category and benchmark. I recently attended a T. Rowe Price press conference and was sufficiently impressed by Rizzo that I asked him to come on WealthTRACK and explain why AI has such great potential.
What's so exciting about AI is that it has so many different business applications. It's not just these chatbot models that are fun to play with, like ChatGPT, or these amazing image models like Sora, but it can be applied to cybersecurity, email drafting, or redeveloping the entire advertising technology stack. And it really comes down to the technology innovations that have enabled AI and how flexible those two things are. And there's really two. The first is on the hardware side, innovation in graphics processing units, or GPUs, from the likes of Nvidia. And the second is on the software side, and that's the rise of these large language models, particularly the transformer architecture of these large language models. That's the T in ChatGPT that allows for such incredible human-like interaction with these AIs.
Are we there yet? I mean, you're talking about potential to be productivity enhancers like electricity was, but where are we in that process?
Well, like all innovations, they take time, right? So we're in the first couple years of this build out. If we think about it, ChatGPT was really only launched to the public on November 30th, 2022. And
right.
So we're still very early in terms of applying these applications to different use cases. If we take traditional computing is really done serially historically. and on these central processing units or CPUs from the likes of Intel. And all that means is traditional computing has been done one thing at a time. These GPUs from the likes of Nvidia process in parallel, which means they do multiple things at a time. And I'll give everyone a quick example to help understand it. If you gave the traditional CPU or the central processor unit the book A Tale of Two Cities by Charles Dickens, and you asked it to read the book and identify every time Charles Dickens says the word the, it would start on page 1 of the book, and it would read, "It was the best of times, it was the worst of times," and it would count out all of the thus. The GPU, on the other hand, rips the book into 100 pages and pulls out all of the thus simultaneously. These large language models then provide those thus contexts. That means they give the reader the understanding that if it was on page 1, the word the was likely preceded by the words it was. It was the best of times, it was the worst of times. And what we've done is basically apply this new technology to ripping apart the entire internet. And we've ripped up the entire internet, and that's how you get all these lifelike interactions when you're talking with ChatGPT. Going forward, we're going to apply that similar technology to many different use cases and company-specific data. If you used a cybersecurity AI to go identify every single time someone has had a cyber threat on your organization and pull out all of the different similarities, similar to pulling out those thus out of the first page of the book, that's kind of one very simple and use case that we could see very, very quickly with the likes of AI.
It sounds like it's a lot of data processing, and as opposed to acting like human intelligence. We had a guest on recently, a guy named Eddie Ardeni, who's a strategist and a financial thought leader, who said, you know, AI really isn't intelligent. It's great at processing all of the these and maybe putting them into context, whatever it is, but it's not making that extra leap. Is it?
You're tapping into a religious war in the AI community, Consuelo. Can computers reason?
Yes.
That's the ultimate question. I would say right now, they are tremendous at probabilities. And the question is, if you're tremendous at probabilities, is it effectively reasoning? Is pattern recognition effectively reasoning? You know, I have a 1-year-old son at home. How does he learn? He learns via pattern recognition, right? That every single time he sees me blow a kiss, he knows that that's an interaction of love. If the AI is studying a bunch of different patterns, can it reason or not? I think that's the question that remains to be seen. I probably fall more into the camp of no, the computers cannot reason today. But can we take this pattern recognition technology and apply it to millions of different use cases to result in a huge productivity boom for the global economy? So you have to, like all new tools, know what they're good for and what they're bad at as well. Are they great for email summary? I think the answer is very clearly yes. Are they great for transcript analysis, pre and post a meeting? I think the answer is clearly yes. Would I still want to check what that summary was, or if I had it construct an email for me, would I still want to check it before it's sent out? Absolutely. But at some point, we're going to get to the point where the AI can act like an agent, where for low value tasks, you're comfortable giving it permission to go ahead and send those emails, send the follow-up. And with that world, that's what really opens up all the different productivity enhancing elements of technology. The area that we've seen it most amazingly is in software writing, because software has a huge depository of historical code that you can go study and pull out patterns from. And with that, we've seen exponential increases in productivities of developers. You know, we're talking many, many multiples of productivity increasing during actual developing time. And what that will do over time is actually drive the cost of software writing to zero. And that has huge implications for the entire software industry.
Doesn't sound like it has good implications for software engineers or programmers, but maybe for the companies?
Well, it depends. This is a great question. It depends on a few things. First off, we all have a huge background of different software that needs to be written at all of our different companies. I can think of all of the different projects that T-Rowe wants to do going forward. And so first things first, let's get those projects done, right? Because there's plenty of them out there. The second thing is if the software is being done by the enterprises themselves or delivered by an enterprise application software company, that's a big difference on who accrues those economics. Is it the Salesforce.coms and the Adobes of the world? Or is it the MongoDBs and the SAPs of the world more at the infrastructure layer? That's a question that remains to be seen, but I think there's a shot more value will accrue to the infrastructure layer than the application layer that it's historically accrued to. And then finally, what does it mean for workers? I think in the short term, it's going to make us all much more productive and free up a lot more time. And of course, AI, if it ends up being on par with the productivity and advancing effect of electricity, will result in some creative destruction. But there's also plenty of other jobs that should follow too.
Are we already seeing the productivity enhancing attributes from AI that you're anticipating?
We're getting there, but it's still early. The first area we're seeing it is revolutionizing the customer service experience. Let's take Klarna, the Swedish fintech company. We've seen them implement AI in 2/3 of their customer service chats today. And what have we seen? We've seen actually better results with the AI than with the human service chats. A 25% reduction in repeat inquiries. And on average, the customer chat time has gone from 11 minutes down to 2 minutes. So right in customer service, we're seeing immediate productivity impacts today.
I've read a lot of T. Rowe Price research. You're doing a tremendous amount of work on AI, devoting a lot of resources to it. And you had a hierarchy of AI that I was reading, the applications and foundational models and infrastructure, chip ecosystems. But in the applications, foundational infrastructure, there are household names. These are the big mega cap, Microsoft and Google and Amazon and Apple and Meta. So it just sounds like the big guys, the big mega cap tech guys are where the action is. Is that right?
Well, it really comes down to this fundamental question. Is AI a sustaining innovation or a disruptive innovation? And that means, do the historical winners keep winning, or are we going to have a new set of winners going forward? And at the chip level, that's a little different. But higher up in the technology stack, on the technologies that we interact with day to day, I think AI is very clearly a sustaining innovation, meaning that the big get bigger. And why is that? One, probably most importantly, is the cost here. We're talking amongst the major hyperscalers, hundreds of billions of dollars of CapEx spent in order to be at the most leading edge. Two, the distribution. Take someone like an Apple with billions of users. You're able to input that AI into your operating system and overnight update it across all of your different user base. And so that's an exciting technology innovation that we're going to see. And three, think about it, your daily workflow. AI will just be implemented seamlessly into your life. And what do most people do on their day-to-day? They go and they shop on Amazon, or they use Microsoft Outlook, or they use a Facebook or Instagram post to interact with friends. And so AI will be interacting directly with all of those day-to-day parts of your workflow.
And those big companies are the ones also that are investing in it. And so therefore it sounds as if in the AI-driven world that those household names are going to be major players for a long time to come. Is that accurate?
Well, funny enough, Consuela, the one name that's become a household name recently, but maybe wasn't historically, was of course Nvidia, whose GPUs and hardware are enabling all of this and are really the linchpin behind the chip ecosystem. So right now, we're really seeing value accrue to the chip ecosystem. These are the semiconductors that are enabling the AI revolution. And the most obvious one that everyone knows is Nvidia, but there's AMD as well, who I think has the chance to be a credible second source. These companies design their GPUs on top of software from the likes of Synopsys and Cadence. They then take those designs and manufacture them at companies like TSMC on top of equipment from like ASML. And what we've seen is these digital semiconductor companies have seen an incredible boom for AI as we've got ready to build out this whole new infrastructure. Like we said before, this GPU-based computing is a completely different way of doing compute than we've done historically. And as a result, we're going to have an immense infrastructure investment. These hyperscalers are investing circa 50% higher more in CapEx and infrastructure in 2024 compared to 2023. And if you look at the AI chip market, it's going from roughly $45 billion in 2023 to $400 billion by 2027, according to AMD. That's over a 70% CAGR. And that's why we've seen such phenomenal growth out of the likes of Nvidia. They've really been the linchpin technology behind this AI chip build out. You know, I was looking at some numbers right before we chatted. The day ChatGPT launched, the street's estimates for Nvidia were roughly $6 per share in fiscal 26. That's their calendar 25 year. At the beginning of this year, that number was $23 a share. Today, that number is $33 a share. So we've seen incredible earnings growth out of some of these companies as we've gotten ready for the AI build.
If I look at the portfolio and the top holdings of the T. Rowe Price Global Technology Fund, Nvidia was number one. As of the end of March, it was 16% of your portfolio. You told me that your best decision since you took over the fund at the end of 2022 was not selling Nvidia. So what's your view of Nvidia now?
Sometimes the best action is no action at all when it comes to stocks, and this happened to be one of those cases. Look, we put all of our stocks through our investment framework. We're looking for what I call lynchpin technologies, innovating in secular growth markets with improving fundamentals and reasonable valuations. And if you rewind back to December of 2022, it's very rare that any company fits extremely well on all four of those attributes, but the entire digital semiconductor ecosystem actually fit very well back then. We were just coming out of a downturn. We were about to have accelerating revenue growth. This AI market was a brand new market, which was going to supercharge demand. These are very high incremental operating margin business models, 60, 70, 80% incremental operating margins in certain cases. And as a result, with that extra demand, we've seen rapid EPS growth. And that example of Nvidia's earnings going from $6 a share to the street having $33 a share is the perfect example of that. Now the question is, where are we in that build out? With regards to Nvidia, how long will they remain this dominant linchpin provider in this build out? I think the answer to both of those questions is we're actually still relatively early, and Nvidia's positioning remains extremely secure at the high end. And with that, I think that we can see significant revenue growth, operating margin expansion, and EPS growth from here still for the company. So we feel comfortable with the large position. Now, in that context, we always think about the entire portfolio, how much semiconductors we have versus how much software we have, how much Apple and Microsoft we have, which kind of act as more like ballast positions in the portfolio. I don't think we've seen in the enterprise before a company that had dominance at both the hardware level and the software level like we've seen with Nvidia. They have the best CPUs, the GPUs, the networking technology, and their software framework CUDA for AI, which is enabling a lot of this revolution. And right now, Nvidia looks pretty good on the investment framework, but the reality is after you grow 200%, you have to decelerate at some point too. You can't accelerate forever, right? You can't grow 200, then 300, then 400%. But we're still decelerating to a very high growth rate for the company.
Firms and portfolio managers sometimes have screens. And so, one of the screens, for instance, has been ESG. How essential is AI and how integral a part of that is it in your investments?
I would say it's absolutely mission critical. So AI is a complete new computing paradigm. What's absolutely essential is understanding how companies fit in that new computing paradigm, because it really impacts whether or not they're still innovating in secular growth markets. We saw names like Salesforce.com and Workday sell off 15 to 20% after just 1% reductions in their guidance. And I think what's happening is the market is trying to figure out has AI changed these companies' terminal values in a negative way? Is Salesforce.com as important to its customers in an AI-driven world as it was in just a normal cloud computing world? So you have to ask this about every single company in the portfolio when you're going through your analysis.
What's your answer to those two examples?
I think we're seeing a complete change in the way software is being written. Software historically was very expensive because it cost developers a lot of time, energy, and effort to come up with creative code. And now with AI, we're driving the marginal cost of the cost of creating new software to zero. And so that opens up a world of possibilities.
A lot of investors, financial advisors, for instance, are concerned about the concentration that individual investors especially have in their portfolios, again, with the mega cap 7, the fact that they make up, I don't know what it is now, anywhere from 25 to 30% of the S&P 500. When you look at the Global Technology Fund, what role do you see you playing in a well-diversified portfolio which just might hold an index fund like an S&P 500 index fund or a NASDAQ 100 index fund? What role do you see your portfolio playing?
Let's start with the Mag 7 piece. Of course, we have market concentration, the likes of which we actually haven't seen before. But these companies are really like companies that we haven't seen before. They grow earnings at more than twice the rest of the S&P 500. And if you adjust for that earnings growth, they're actually cheaper than the S&P 493 on a PE to growth ratio. So I actually think that the valuations remain relatively reasonable for the Magnificent Seven, given how fast their earnings are growing going forward. If we think about how my strategy plays into allocation, obviously I'm highly focused on innovation, trying to make sure that we find those few linchpin companies that are innovating quickly in a rapidly changing environment. And like we said earlier, I think AI has the potential to be the biggest productivity enhancing technology since electricity. If you go study productivity enhancing technologies, they've often resulted in speculative bubbles, actually. So if we look at the railroads or the telecom bubble, China was an incredible productivity enhancing effect on the global economy. And so my role as a capital allocator is to make sure that we navigate those potential speculative bubbles responsibly. And the way we do that is by having a repeatable investment framework where we look for linchpin technologies, innovating in secular growth markets with improving fundamentals and reasonable valuations.
One investment for a long-term diversified portfolio. This is a question that every portfolio manager hates. It's like choosing your favorite child. But is there one investment that we should all own some of in again, long-term diversified portfolio?
If we take a step back and we look around the world, what is the ultimate linchpin technology? And I think that may be at ASML in the Netherlands. So ASML manufactures the extreme ultraviolet or EUV lithography machine. This is the mission-critical machine in the semiconductor manufacturing process that prints the design of the chip onto the wafer. I really think these guys could have won a Nobel Prize for what they've done with this machine. Each one costs north of 300 million euros for the latest version. They take 12 different trucks and 3 different 747s to distribute from the headquarters in the Netherlands to the manufacturing plants, either in the US or in Asia. And without this company's innovation, we would really see innovation meaningfully slow.
So Dom Rizzo, lots of neat ideas, really interesting approach as well. And looking forward to tracking your continued progress at the T. Rowe Price Global Technology Fund. So Dom, thanks so much for joining us on WealthTrack for the first time. We appreciate your being here.
Thank you, Consuelo. Hope to be back soon.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is consider doing some rebalancing in your stock portfolio. The price of anything AI related has now appreciated. And not to equate the two, but remember when anything with .com attached to it was also hot. As just discussed, artificial intelligence has great potential, but not to the exclusion of other essential businesses. Right now, Benjamin Graham's famous Mr. Market character is offering AI investments at spectacularly higher prices than they were just months ago. This is as good a time as any to look at other less popular areas. Morningstar's analysis: value and small cap stocks remain most attractively priced for long-term investors, and real estate, energy, and consumer cyclicals are the most undervalued sectors. Rebalancing doesn't mean abandoning winners, far from it. It just means taking advantage of Mr. Market's overlooked bargains. Well, next week, the evolution of Warren Buffett's investment approach. Lawrence Cunningham, editor of the bestseller The Essays of Warren Buffett, tracks the changes. In this week's extra feature, Dom Rizzo explains his focus on technology and AI as an analyst and portfolio manager. Please follow us on Facebook, X, and our YouTube channel. Thank you so much for spending time with us. Have a great weekend and make the week ahead a healthy, profitable, and productive one.